Okay, hit it.
It's May 29th, 2020, episode 82. I'm Patrick Ceresna.
And I'm Kevin Muir. This week, macro strategist Andreas Steno Larsen of Nordea Bank joins us to talk about what he thinks is shaping up to be a pretty big opportunity in European assets. Then an old friend of the show, Aidan Garrib of Pavilion Global Markets, gives us his take on the U.S.-China trade war. After which, Patrick talks a little charts.
And then this week in trading history, we look back to the birth of a great mathematician. We get to the WTF clip of the week, and then we finish off with the top 3 things to watch next week. So let's get to the interview.
Andreas Steno Larsen is the Chief Global FX Rate Strategist at Nordea Markets. Andreas brings a unique European and Scandinavian viewpoint to global macro markets. Although Nordea Bank might not be as well known in North America, I've often found their research to be of the caliber of top Wall Street strategists, and we are fortunate to have Andreas join us today. Welcome to the show, Andreas.
Thank you very much.
Well, so this has to be a market huddle first. We've had people that have squeezed us in terms of their timing, in between vacations or in between meetings, but I've never had somebody that is squeezed us in right before a wedding. So let me just first of all say, Andreas, you're getting married tomorrow. Congratulations in advance.
Thanks so much. I have a very angry wife to be in the living room right now, but due to my bad timing. But that's how it is sometimes.
You were a trooper to agree to it. We could have actually put you in another kind of time slot, but thank you so much. Yeah. Maybe it's better that you be talking about markets instead of worrying about your wedding jitters.
Yeah, it just goes to show how absent-minded I am from time to time, right? I have a very, very big block in my Outlook calendar tomorrow morning saying, remember that you're getting married. And I got that from my wife after the appointment.
That's nice. Okay, so let's chat a little bit about your background. And you're a young fellow, as obviously you're getting married. You're a young guy. Can you tell us a little bit about where did you go to university and what was your kind of career path to where you are now?
Yeah, I'm born and raised in Copenhagen, Denmark. So that was also where I went to university. And I have a master's in finance. And before I graduated, I actually already started at Nordea Bank where I work now. So I've been there 11 years, thereabout, already. And I basically started as a junior right after the Lehman crash. So it was a pretty weird experience to enter a trading floor with zero experience at the time. But since then, I've sort of grown my way into the organization, I guess.
Right. And so you're part of the macro group? Like, how do you describe your group, or is it the research group?
Yeah, well, I call it the institutional strategy group. So I basically take care of the research offering towards institutional clients worldwide, hedge funds, central banks, asset managers, etc.
And I've seen your products on Twitter for a long time now. Your co-part there, Martin Enland, is being somebody that I've long admired in terms of his work over the years. Why don't you tell us a little bit about Nordea Bank? Because it's actually some top-notch research that comes out of your shop, and I think a lot of people aren't aware of it.
Well, I mean, we're a big Northern European bank, I would say, headquartered in Finland, actually. That's mostly on paper. We have the biggest trading operation out of Copenhagen, Denmark. And then we're, of course, a big Euro bank, but mostly a big Scandinavian bank. So our niche in the shop is basically Scandinavian currencies, etc. But we also have a good offering on dollars. And we struggle to keep our mouths shut on dollar markets as well, even though we're far away from them.
Yeah, funny. You should never let not being in the midst of it stop you from having an opinion. We as Canadians know that all too well. So when you're doing your trading, do you guys specialize mostly in just the kind of Scandinavian currencies, or do you also trade like obviously you're trading against the euro, the euro and stuff, but will you actually go and do, more traditional like S&P 500s and stuff, or are you mostly an institutional kind of foreign exchange interest rate bank for Scandinavian clients?
Well, I mean, we are like a global shop for Scandinavian clients, and then we are a niche Scandi shop for global clients. I would put it like that. like that. So
Oh, okay.
we also cover like central banks, hedge funds worldwide with Scandi products. I know it's a niche, but a lot of players are still active in particular the Swedish market, around Asia, also in the US.
Right. And so, no, I understand that model very well. We as Canadians have the same thing. You know, the banks here will cover Canadian clients on a global basis, and then we'll cover global clients on Canadian products. So I understand the very similar kind of model that we have. I guess that's just part of life being the smaller country.
Yeah.
But in terms of hedge funds, are there a lot of hedge funds in the Scandinavian countries?
Not really. I mean, it's a pretty big business in Sweden. Less so in Denmark due to the boring markets we have here. And then otherwise, no. I guess Finnish institutional clients have some sort of hedge fund-ish mandates, but otherwise we stick to selling hedge funds outside of Scandinavia.
Okay, so you're in the heart of Europe there, and we're going to talk about some of your Europe kind of views. And you were telling us before the show that you become Euro bullish, European asset bullish. Let's chat about that. Why? What's kind of sparked this newfound enthusiasm for European assets?
Well, I guess this whole new or next generation European Union, as has been suggested by the European Commission, I guess it will have a much deeper fiscal integration, and also a much larger extent of cross-border economic solidarity. I guess at least if the chief advocate of globalism, Emmanuel Macron, wishes are fulfilled, that's the case. And I guess right now, if you look at what's on the table, large euro grants are being provided to Italy, Spain, Poland, for example, if the current debt proposal of the European Commission comes into fruition. And even though I can see all sorts of long-term warning signals about such, I would say that it should be taken as a bullish sign for the euro area if they finally manage to set up some sort of fiscal union in de facto terms, and that's essentially what they're suggesting, I guess.
So do you buy that this is something that has a good chance of passing? Because in the past we've kind of had these carrots dangled at us before, and like when you put a carrot in front of a donkey on a fishing pole, the donkey never seems to get it. Is this just another example of that, or do you think that this one has teeth?
But I think Merkel and Macron, they should say thank you to Nigel Farage, because after the UK left the European Union, or at least are on their way out, it has turned much more easy to get things like this through. So usually we had what we would call the frugal five, so UK, Denmark, Sweden, Austria, and the Netherlands being against everything that looked like cross-border solidarity.
Right.
Now it's basically only four countries: Denmark, Sweden, Austria, and the Netherlands, and it's just a much less potent group without the UK. So I guess that leaves a pretty fair chance that France and Germany will literally just run over the opposition right now.
But you mentioned this frugal five that's turned into the frugal four, but wouldn't you have included Germany in that five? Shouldn't it really be in the frugal six?
In a sense, yes, but I think things changed when Germany put their own person in charge of the European Commission. When Ursula von der Leyen was appointed to head up the European Commission, they also sort of took the step towards leading the European Union towards much deeper fiscal integration. And I think it was a smart move if that was really what the German administration wanted. And it seems like now that the German administration is willing to basically give the middle finger to the German constitution, first of all. And secondly, also they're willing to pay a much larger part of the bill than what they've been willing to so far. So something has changed in Germany, or in the head of Merkel, maybe.
And that change at the leadership of the EU, that occurred at the same time as Madame Lagarde taking over in terms of the ECB. Was that not correct? So do you think that was all part of like a coordinated larger plan, and that these are all just chess moves on the way to a kind of a more tight fiscal integration?
Yeah, it seems like it. I mean, both politicians and central bankers in the euro area, they basically now uniformly want to atomize everyone betting or working against the common currency. So this is sort of the final push towards getting the euro to work. We've known for the past decade that the euro is a bad construction, but it may be a better construction with a fiscal union attached to it. So they will give it a chance, I think. And this is a massive game changer for euro markets because, I mean, the last 3, 4, 5 years, even with a more calm market around Southern European debt, you still see that people they continue saying that long term the euro is doomed. So it kind of puts a weight on its shoulders that this risk, that this very fat tail risk, was always there. I guess it's still there, but it's just less visible now.
Do you think that the number, which is what, half a trillion euros in terms of grants, and then another 250 billion in terms of actual loans, do you think that's a big enough step in the right direction with the Americans throwing around much bigger numbers in terms of their economy? Do you think that this is something that'll actually move the needle for the European economy?
Well, yeah. If you flip to the next chart, Patrick, I actually send you a chart on how to look at this. I mean, if we assume first of all that both the current debt deal is implemented, and then also that the ECB increases the pandemic purchase program by another 500 billion, that's the consensus for next week. Then we get, I would say, a much more benign QE versus issuance ratio in the euro area this year than what we would have expected like just a month ago. So the gray scenario I paint on this chart is ECB QE plus the grants minus the euro area issuance. And I have taken a very conservative, I would say, measure of issuance here. I basically almost double the official projections from each of the debt offices. And here we get on the gray scenario with both the debt deal implemented and also the ECB QE being prolonged and widened, a scenario with more being bought by the ECB than what is issued. I think that's pretty bullish. The dark blue area is the scenario without a debt deal and without an increase to QE. So the outcome space is pretty large, as you can see. And then on the right-hand side, I have the spread between Italian and German bond yields in the 10-year space on a reverse scale. So up in the chart means tighter spreads. So what I'm saying is essentially that if both these things are being implemented, then spreads can widen maybe 75 basis points more. Usually when they do so, it's a sign to buy the euro, in my sense, in my view.
Right, because I guess to some extent, the sentiment towards the euro is just so bombed out, right? Are you seeing that? Like, that's definitely what I've noticed, but have you seen the same from your kind of talks with big clients?
Yeah, I mean, when I go to London and try to pitch a positive euro story, I'm almost being blown out of the room every time.
Yeah,
I mean, they just hate.
Booed out of the room. Listen, there's no better trades than those, Andreas. When everyone tells you you're wrong, you got to double it up.
Yeah. True, but I told them I had a tour with a euro positive story in 2019 as well. Not a good timing, honestly. So I guess this time I need to be even more reassuring when I'm over there.
So you have a situation where global clients are probably underweight the euro, where there's a lot of skepticism built in terms of the ability of actually Macron and Merkel to come together and actually do a fiscal union. So would you argue that even if this isn't a solution that's big enough in the long run, it's something that's just going to move the needle in the right direction in the short run?
Yeah, I guess that's exactly my take. If we go back to, was it 2012 when Mario Draghi held his famous whatever it takes speech, I think euro dollar moved from 122 to 131 or thereabout, just over the following month. I basically think that this debt deal is signal wise something of similar magnitude to what Draghi did in 2012. Basically, telling markets that there is a uniform thinking within the European Union and we stand together. Of course, it can still be blocked by one of the small countries. You should remember that deals on common debt needs a unanimous decision making. So essentially, our prime minister in Denmark could block it if she wants to. I've spoken to sources within the administration, and they still hate the deal, but of course they hate it because we need to pay more than we get back to be part of it. But still, I mean, we're 5 million people in Denmark. Are we really willing to pull the rug from under the euro just to block this deal? I don't think so. By the end of the day.
And are you guys generally considered the most hawkish? You mentioned like the Denmark.
We and UK. And now UK is out.
And the UK is gone.
I guess we take the throne now.
So you're the most hawkish when it comes to these things.
Yeah.
So the other three in the frugal 5/4 now, they'll most likely go in line, and if anyone's going to vote against it, it's you guys.
Yeah, that would be my take. Yeah.
And so what do you think this means for markets like the Bund? Could we see a situation where the Bund no longer trades like I don't know, like the Twilight Zone, how it's negative? Could we see a situation where we actually get up to positive 50 or even 100 basis points and a more realistic situation?
Well, I think that direction is the right one to call for now. Also, given that if we assume that this deal goes through at the EU27 meeting, then of course, if you look at the sort of the receiving end of the grants, it's everything from France to Italy to Spain to Poland that are in the receiving end of the grants. So essentially, someone has to pay for that. And even though I said Denmark would be a net payer, it's of course Germany. So they will take on credit risk indirectly that they haven't taken yet. I guess that could lead to higher interest rates in Germany, but lower interest rates in countries that are on the receiving end.
So I know you're not an equity market specialist, and that you do, from what I see, it's more about bonds and foreign exchange. But what would you think would be one of the countries that would benefit if you were looking at equity market to buy? Obviously, you mentioned France and Poland. Are those the ones to buy, or is it Italy? Like, what would be kind of the expectations you might see in the equity markets?
Yeah, but if we look at year-to-date performance, then I think outside of the Nordics, then the German DAX is probably the best off in Europe. So essentially, I would look to buy those indices that are bumped back a couple of years in time during this Corona crisis, and Italy could be a good bet. I know that it would be super contrarian to just go massively overweight Italian equities, but if I'm right that this deal goes through, then I think it would be a pretty decent bet.
And do you think this deal going through is enough to quell the populist movement in the countries like Italy?
That's actually a really good question, because, I mean, even in the midst of all this turmoil in the euro area, we've seen super good polling for the Northern League, I think they're called that in English, Lega Nord, and they are sort of waiting on the sidelines to see whether they get a good chance of claiming power over the next year and a half. That's a tail risk to my view, because if they enter the administration offices, then I'm pretty sure that we will have another discussion in the European Union pretty fast.
Kind of one of those countries electing a populist leader, you think is enough to actually derail the whole European experiment? Would you change your viewpoint if one of
I'm in particular scared of Matteo Salvini getting a majority in Italy. He's been really, really firm on his anti-Europe rhetoric. So that's basically tail risk as I see it. But right now, I wouldn't assume that he could win an election. It would be close, but I wouldn't assume it. In particular, not if Germany accepted to pay a large sort of grant or bill on behalf of the Italians.
Do you think the Italians understand the financial situation of the reality? Like, do you think that, or does it end up just being more of a?
But if they
go ahead.
But if they understood it, they would have left the euro ages ago. I mean, I think so. No, I mean, Italy's basically been sort of worst off, I would say, during the euro. If you look at the GDP chart on Italy, Italy was growing at let's say 2.5-3% a year up until 1999. That was the exact year when the euro was introduced, and then it's just flatlining GDP growth ever since. I mean, they've moved nowhere for 20 years.
And so, why do you think that is? Like, I have my theory, but I'd love to hear yours.
Yeah, I think in short, the ECB has had a too firm monetary policy stance throughout, at least for Italy to perform. So if you set the monetary policy in the middle of the road, then it would always be a policy that is sort of too firm or too hawkish for the Italian markets. So that's my number one theory, that Germany has gotten an easier monetary policy than they would have otherwise had, but Italy has gotten a more hawkish monetary policy than they would otherwise have had. Yeah.
But Andreas, how do you have a more easy monetary policy with negative rates? Don't you agree that as you go more and more negative, that it's actually counterproductive and that it actually hurts the economy?
Yeah, but if you look at it from an Italian perspective, I guess they would actually have liked to be able to print liras now. It's much easier to tackle a debt crisis when you have a central bank that can print your own currency. And
Sorry, go ahead. I didn't mean to interrupt.
Yeah, but and essentially it's an issue for them that they always need to go via Frankfurt when they need to print money now. They would have been much better off with a lot of devaluations and a lot of printing of liras, I think.
Right. Well, and then the other thing, though, is that wouldn't you agree that maybe the fiscal restraints that are placed on all these countries are too tight? Because, the Germans get all mad at the Italians, and the Italians are running a 2.5% to deficit to GDP. Meanwhile, the Americans are running 4.5%. And it's just it's in a different world, and it's introducing, I don't know how much easier you can be on the monetary side, because I think that they've actually hit the zero bound and then it becomes counterproductive. But I would argue that they could be much easier on the fiscal side, and whether that be less taxes or more spending, I don't really care. But wouldn't you agree that that's probably the real issue?
Yeah. And first of all, you would have never gotten to negative interest rates with an easier fiscal stance, I guess.
Yes,
so that's maybe question number one. But in terms of the Italian fiscal stance, I know that they've been sort of okay on the Maastricht Treaty over the past 2-3 years, all of the assumptions made in that one with the minus 3% of GDP deficit and all that stuff. But otherwise, if you look at the years from 2000 until 2012, something like that, basically no one within the euro area lived up to the minus 3% deficit targets outside of Germany. Even France didn't do so. I recall that if you look at the official numbers from Eurostat, I think the year before the euro was implemented, suddenly all of the southern European economies had a deficit of minus 2.99%. It was really funny. And I even think Greece hired Goldman Sachs to make some sort of adjustment to the number. And it was just a complete mess. And basically, as soon as the euro was implemented, they started breaching the rules again. So I'm not really sure that I buy that they've been super constrained by Germany. It's true over the past few years, but over time they've been breaching the rules year after year without any real damage done on the relationship to Germany.
It's funny because you mentioned that the 2.99%. I have a friend who spent some time in China, and he used to tell me that in Beijing, I think if it goes over 38 degrees, that you have to stop working in all the factories or whatever. And the amount of times that it goes up to 37.5 degrees and just sits there, it says it happens all the time. I can't remember what the number is. Maybe it's 36, but at some point, and it just never goes above that. So let's talk a little bit more about Europe and the other possibilities of what you can invest in. Like, what would be the other pitches that you might be giving someone in a hedge fund based upon your theory? What are other attractive trades out there?
I would buy Italy versus France. I think that's a good bet right now. And one overlooked reason why that is, if you look at corporate debt, in France,
I have
been,
this chart right here, right? This is the one that you had on Twitter, right? Is that your corporate debt one?
Yeah, it's a good chart to show. Because if you look at it since 2008 or 9, then both in Italy and Spain, you've actually seen a massive deleveraging process by corporates. But in France, they've been building up debt year after year after year, even during the debt crisis in the Eurozone. So from a corporate perspective, I would actually say that France is a much riskier bet than Italy and Spain. And just to give you a flavor of how bad the situation is in France, I mean, France should be one of the economic strongholds of the European Union, but they are actually pretty firmly on the receiving end of the grants in the European Commission's suggestion. So it basically means that only Germany, Netherlands, Austria, and the Nordics will pay the entire bill, which makes it a pretty big burden for those 4 or 5 countries.
Okay, so Italy versus France is a trade that you like. What about the Scandinavian countries? Is there any opportunities there?
I have learned by lesson, I would say that you should never ever buy the Swedish krona. They've basically been running a killing machine of the Swedish krona and the Swedish Riksbank for the past decade almost. At least as long as I've been in charge of our FX views, I haven't really been positive on the Swedish krona on any occasion. So, but that was just for the fun of it. I actually think that if you look at it from a Corona perspective, it was actually the first time we mentioned Corona. We made it to half an hour without mentioning it.
Yeah, that's right.
Pretty impressive. Yeah, but if you look at it. First of all, from a consumption perspective, on the card data that we can track on a daily basis in Nordea, we are big in all the Nordic countries. We are actually already back at index 100 on consumption today.
Oh, really?
Yeah. So it's been a pretty material V-shape in consumption. The interesting thing is that consumption venues have changed, and the consumption mix has changed.
Right.
But the consumption is back on 100 volume buys versus 1st of March already now.
Wow. Okay. I've actually.
So I guess that's a pretty bullish story for Scandinavia in general. Because that's certainly not the case around Europe.
You don't think? Like, do you track it versus other countries as well, and it's not the same?
Yeah, well, just to take an example, like Swedish retail sales was down 1.4% year over year. This month, while it was down 30% year over year in Spain. So it's quite a big difference.
Oh, okay. And why do you think that is? What's the thinking behind that?
I mean, first of all, the reason is that we've managed to contain the virus spread pretty effectively, at least outside of Sweden. And now I admit that I don't really like the Swedish strategy, but if you look at Denmark and Norway, essentially no one carries the virus right now. We have like 20 new cases a day or something like that. It's just nothing. And when I look outside of my window, I live in the middle of Nyhavn in Copenhagen, so basically a restaurant area. Everyone's just sitting on restaurants, having beers, smoking cigarettes. Everything just seems normal.
Oh, really? So you guys are not in
Yeah.
lockdown at all, and you're not practicing like your waiters and waitresses aren't sitting there with masks on and stuff.
Nothing. It just looks normal.
Ah,
wow!
It's because you're keeping all of us North Americans and everyone else away.
Yeah,
you locked it down in time. Like you locked it down in time.
That we've locked down. I actually think that the reason could be sort of the level of trust in Scandinavia between people. So for even voluntarily, we started distancing in a smart way before lockdowns were implemented and all that stuff. I know I sound really, really home biased now, but I think the numbers, they back it up.
There's nothing wrong with there's nothing wrong with being home biased there, Andreas. For example, we're the best hockey team in the world, and nothing will ever stop us from thinking that.
Yeah, and I need to sell a Scandinavian bond here and there to pay my salary. So
that's right. Okay, so you mentioned Sweden, and you mentioned that you're not a big fan of their strategy. And why don't we walk us through? Let's talk a little bit about the virus, because Sweden is kind of portrayed as this template for the rest of the world. I take it you don't feel the same way, and why don't you walk us through your feelings about that?
Well, I mean, in an international setting, I would say that Sweden has done pretty okay. So let me put that up there first. But in a Scandinavian setting, they have been clearly worst in class. If you look at fatalities per million, they are like tenfolds of what's been going on in Norway and Denmark. If you look at their testing strategy, they haven't tested nearly as many people as we have in Denmark and Norway. So they are, I would say, behind the curve on some of the smarter moves that you can do to contain the virus. First of all, just test everybody. They've been really behind the curve compared to Denmark and Norway on that one. And therefore, I think even though they kept parts of society open, they've actually ended up in a worse situation than Denmark right now. Because if you look at surveys, first of all, most Swedes, they answer that they're scared of catching the virus. That's not the case in Denmark. A clear minority is scared now in Denmark, while it's a majority in Sweden. So that also kind of spills over to how you consume. Even if restaurants are open in Stockholm, they are still like at index, 40, 50, if you look at cart data, because people don't go there. And as far as I can see on the latest couple of days of cart data here from Copenhagen, it seems like the consumption also in restaurants is rebounding rather swiftly. So I think it has lost a lot to do with whether you've actually managed to contain the virus in a smart way. As soon as you've contained it, then consumption can actually return pretty swiftly. But if you don't manage to contain it, then consumption will never return, basically.
Right. So I'm just looking at your Twitter feed here, Andreas, and I see you're having a good laugh about you finally made use of Thomas Piketty's book. I take it you're not a fan.
No, but honestly, I haven't read it. But it's always good to make a conclusion before reading.
That's right. Listen, not having read it, there's no reason to not have a very strong kind of dismissive opinion about something. It doesn't stop us in the least. One of the things I've noticed about you guys is you're big, huge chart users, and you have a million of them. Can I ask, what do you guys produce those charts? Is it just Excel, or do you have something else? And because it doesn't look like it's anything that's out of kind of a standard Bloomberg or anything like that.
Well, I actually use a lot of Bloomberg data, but I create the charts in a program called Macrobond. It's a Swedish software system. So it basically has like a plug-in to all statistical databases that are worth noticing, everywhere from China to US to Scandinavia. So a fantastic statistical database and it's super smart software tool to create charts. So Macrobond, it's called.
Yeah,
I hope I gave them a few signups.
Yeah, I've actually heard I've talked to guys, and it seems to be a big in the hedge fund community in London uses that a lot. It's actually doesn't seem to be as big in New York and over here, but I've definitely noticed that. And so all these charts are created in Macrobond.
Yeah.
Oh, okay. Sorry, Patrick, did you want to say something? Go ahead.
Yeah, no, I wanted to get him talking a little bit about what's happening here in the world. Like you had this one chart right here out in on deflation, you obviously we're in this big global slowdown, or let's call it a global recession. And how does this play out in your mind? I mean, we're still in some form of a deflationary impulse, but how long do you think this takes to kind of see the turn point? I mean, is this just a matter of the global economies opening up here in the next month, or do you think it's a more of a U-shaped recovery? Like, how do you see all of this playing out?
I think it depends on geography right now, because given the card data that I mentioned on Northern Europe, I would actually say that I'm pretty bullish that we will have something quite close to a V. I'm certainly not as optimistic when I look to the UK. I would argue that they will get de-locked down as the last big country in the world. It still looks quite messy over there if you look at the virus. So in that sense, I even got the feeling when I listened to Bojo, was it today or yesterday? I don't even recall that now, that the UK will basically stay in a lockdown through Q2. That's pretty bearish compared to expectations, I guess. And I guess the same could be said partly about the US, that you still have regions that will struggle to really regain momentum, at least this quarter. And it will take a while into the third quarter before momentum really starts to gain pace in the US. So I'm a bit caught in between stools here. I think certain areas will see a V shape, but big countries will probably face a U shape.
Well, Andreas, we don't want to keep you too long because you are getting married tomorrow. And usually I kind of ask our guests for some sort of looking back at life, what they might have done different. You're obviously too young for that, but I will ask you this. If you were to go...
Is it now that I should say that I wanted to marry another woman?
No, you shouldn't say that now. And actually, I'll give you one piece of advice on marriage that the guy on the desk told me, and I just feel like I should pass along these words of wisdom. He always said, never do something once that you're not prepared to do for the rest of your life. Meaning that, like, if you go do something, you take her breakfast in bed on a Sunday, you're going to be doing that the rest of your life. So be careful about that. But no, I'm just, in all seriousness. Yeah. Sorry, go ahead.
Yeah, one of my clients told me today that that I had the worst timing of this marriage, because as soon as Denmark was sort of de-locked down, then I entered a permanent lockdown.
Yeah, you've mistimed your marriage. Yeah, no, I actually we all wish you nothing but the best in a happy life together. But one of the things that I'd like to ask you is that you've been in the business more than a decade now, and obviously you joined at the height of a crisis last time, and here we are in another crisis. If you were to kind of see someone that's graduating with a degree, and what advice would you give somebody that's interested in the markets today? What would you give kind of a young person coming out of a degree in finance and feels like they can't make it and this is going to be a terrible environment? And what piece of advice would you give them?
Well, first of all, I think it's important to listen to sort of alternative sources of information. You never get an edge just by reading mainstream media. And a podcast list like this one is a good way of getting information from sources that are not necessarily consensusy. So I guess that's a really important advice if you want to have an edge on markets, that never just read Financial Times. I mean, you would basically be 48 hours behind the curve all the time. Was that too rough on them? I don't know.
Yeah. No, you're absolutely correct. Yeah. So go ahead.
I mean,
I
they probably won't quote me now, but
Yeah, that's right. Don't worry, they don't listen to this.
So, Andreas, I
no,
had
they
to
certainly
ask you.
don't. Yeah.
Andreas, I want to ask you because there's an old truism of the youth is wasted on the young. But on your Twitter handle, you say the young body, old brain in your description, and so clearly you've figured out some secret sauce on how to solve this problem. What was it behind? What's behind your little quote there? Just trying to be cheeky?
Yeah, I mean, I've always been told by people that I sounded older than I looked. I guess that's, and I also, as you can see from my Twitter now, I chose a profile picture where I looked like a baby, right? So, I guess that's the reason why I've always sounded older than I've looked.
Well, you go. Andreas, we'll let you go get married, buddy. Thank you so much for taking time.
Good luck on that.
Yeah, all the best.
Thank you so much. It was a pleasure to join you.
Yeah, it was terrific. Thanks again. And listen, you know what? When you guys are coming on your honeymoon to Toronto, make sure you look us up.
Will do.
Okay. See you later. Thanks again, Andreas.
Thanks. Take care.
Okay, Lena, hop on there.
All right.
Hello.
That was a good interview, right?
It was terrific. It's great to have the European viewpoint and another millennial.
Oh yeah.
Although I was a little upset in the pre-show taping portion when he called us, both Patrick and I, boomers.
Oh, I was insulted.
It's a fine line.
I was insulted.
It is. I know I was just insulted, but I do find it funny that the millennials often don't understand the difference between a Gen X and a boomer.
They lump us all together.
They do. They just lump us. Basically, anyone that's older than them is a boomer.
That's right.
And they don't realize that we just would love to sit back and watch the two of them fight. We just don't care.
Yeah. Just don't care.
We don't care.
Anyways, millennials. Yeah.
Let's do our beer. You know what? I'm boring. I'm still drinking through my 50s. My Labatt Saint.
Yeah, you know what? It's not even worth talking about.
I know. Don't talk to it. Okay.
Let's forget it. You know what? This is embarrassing because we were supposed to go and grab the beers. Next week, I guarantee you, that's it. I'm going to get in the car. I'm going to do personal delivery. We're going to have the sponsored beer come in, and we're going to distribute it, and we're going to officially get back to it next week. Promise.
It is.
I've got this Junction Hazy IPA, the one I was drinking last week. It was really good. A little strong, so I'm going to get slurring by the end of this episode.
It's already started.
Yeah, nothing new there. Nothing new there. Lena, what are you drinking?
I had to rummage through my freezer to find some old rum.
Yeah.
So I got some rum and Coke.
This worked. I'm drinking 50. You're drinking rum and Cokes from your freezer. This is just, it's sad.
It's ugly.
The quarantine is sad.
It's getting pretty ugly right now. Yeah.
Okay, let me do our legal stuff. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. Side effects of too much huddle may include Hong Kong dong, probably from those pesky extradition flare-ups. Fact check fatigues. And this is my favorite. Well, let's see if I can get it. The Ackman buffet dumps. Oh, sorry. I got that wrong. It's actually Ackman Buffett dumps.
Oh, there you go. Butchered. Anyway, we have to go on before this gets any worse. All right, let's get the second interview in with Aidan. So we have the privilege of now being joined by a Market Huddle favorite and one of our good friends, Aidan Garrib, over at Pavilion Global Markets. How you doing, buddy?
Patrick, I'm doing well. Just having some of that Operation craft beer.
Oh,
How
nice.
are things over there?
We haven't had a chance to do a featured beer for a while because we've had logistical issues of distributing the featured beers, so we're all drinking whatever's left in the fridge. But anyway.
I live right beside a beer brewery, so it helps with distribution.
Oh, there you go. I'm gonna have to come visit you after all this is said and done. Then, all right. Listen, dude. You had a great piece, and you forwarded it to me, and I read it, and I was like, we got to get you back on the show to talk about this. So here, let me just pull it up over here. And so you did this piece on the U.S.-China tensions and the solution to the Triffin's dilemma. And so why don't you give all of our listeners a quick rundown of what the issues are and what you're seeing and how everything is evolving?
Sure. So I think what we're seeing right now, and I use this cartoon here on this page, is just what we're seeing is this breakdown of the political order that came about post World War II. And I think the market was really thinking about it as if, it's a trade war and we're going to get past it. And every time there were kind of rumors of it getting better, the market rallied. But I think it's a deeper, more longer lasting issue, and I don't think it's going to be resolved as quickly. So essentially what this order rested on, before I get to the images on this chart, is that following World War II, Europe was totally decimated. They just had this long history of wars and mercantilism as they fought, and they really fought over one thing, which is this phrase that if goods can't cross borders, soldiers will. So they were just fighting wars over hegemony and who would have market access to the rest of the world. So they were decimated after World War II, and so the U.S. came to them and, like the Godfather, made them an offer that they couldn't refuse. So essentially, America would help Europe export their way back to affluence by being the consumer of essentially first and last resort. So the U.S. would just buy up all of Europe's exports and help them export their way back to affluence. Now, the beauty of this system is that it was completely scalable, right? You could offer it to Japan and help Japan rebuild after the war. And you could offer it to Canada. And effectively what would happen is the US would protect all the sea lanes and absorb all the world's imports as long as the world bought US treasuries, right? And that's how the US came to be the global reserve currency, and US treasuries are the global reserve asset. Now, right. The problem is that the sinews that bind the system have started to fray. And what this chart or this page shows you is over the last 20 years, the four kind of big episodes of fraying of that. So on the top left, you can see a picture of China and what is the 9-dash line or China's claims to the territory to the South China Seas. And so in April 2001, China downed a US spy plane over the South China Seas, effectively pushing back on America's hegemony, saying, America, your military hegemony ends here in our backyard at the 9-dash line in the South China Sea. Now, China hasn't been the only source of fraying in this relationship. So if you remember, the relationship was effectively, you export your stuff to us, but you buy treasuries and we will be the global policeman, so to speak. Right. Well, after 9/11, George Bush wanted to invade Iraq, and he tried to get U.S. allies on board. But the response, particularly from Europe, was underwhelming. So Europe, who had signed on, who was the first party to sign on to this world order, effectively pushed back and said, you know what? Yes, we want to export our stuff to you. We'll buy your treasuries, but the military leadership thing, it doesn't work for us this time. That was exacerbated later on in 2014 when Putin invaded Crimea and annexed Crimea, invaded Ukraine and annexed Crimea. And the Europeans were waiting for the U.S. response. Well, okay, now's the time, flex your muscle. And the response from Obama, again, was a little bit lackluster. And Crimea is still annexed and is territory of Russia as we speak. Now, the fourth and what I call, maybe the most visible pushback of the system is characterized on the lower right-hand picture here, which shows you the EU foreign minister standing shoulder to shoulder with Iran's foreign minister at the UN in New York City, where they were openly discussing ways to bypass US sanctions and SWIFT and conduct trade with Iran outside of U.S. sanctions or circumventing U.S. sanctions. So you can see here that the system where U.S. buys, imports from the rest of the world, sells them treasuries, and protects the rest of the world in the sea lanes started to fray. So this really has, very little to do with trade, as you can see in the next slide. In fact, if you are the global reserve currency, which the US is, then by definition, you need to run trade deficits, right? Because there's going to be a demand for dollars globally in excess of what the US would provide on just the trading relationship. So regardless of US exports, India is growing by 5% year over year. India needs 5% more oil to accommodate that growth. Oil is denominated in US dollars. India needs more US dollars. So there's always going to be this demand for the global reserve currency. And what this chart's showing you here is that the trade war, quote unquote, has very little to do with trade. The US has been exporting jobs and running trade deficits well before China joined the WTO in 2001. Did China exacerbate those troubles? Yes, but trade really isn't the focal point here. If trade was the focal point, then you would see the U.S. starting trade wars with Mexico, with Germany, with Japan, with South Korea, with the big global exporters. But it's not. Its ire is so far strictly focused on China. So if it's not about trade, what is it about? So you start to see this on the next slide. And here I've kind of laid out this narrative that could sound very much like conspiracy theory. So what I do on this slide is I give you quotes by very senior officials at the Council of Foreign Relations and the European Council on Foreign Relations that reinforce this view. So these aren't crackpots writing in some conspiracy theory papers. These are people who influence global monetary, fiscal, and political policy among global elites. And so what the trade war here, quote unquote, is really about is that the Made in China 2025 plan aims to make China, aims to raise their domestic content or make them self-sufficient across a wide variety of high-tech products. And so we wouldn't have a problem with China doing this if they were going to kind of come into the global fold, much like Germany did after World War II or Japan did after World War II. But that's not what's happening. As you can see on the bottom left-hand blurb of this page, the US and Western democracies have been disabused of the notion that China is going to become more democratic and more capitalist as it gets wealthier. They're trying to really build their own system to the exclusion of the West and become self-sufficient. And this is a pushback on the overall system. So this is what the trade war is really about, which is two systems starting to clash. So you could see here why it's not working for the US. However, it's also not working for China, which you can see on the next slide. So China is a relatively poor country. GDP per capita is about $11,000. So it doesn't have enough wealth or income to drive a self-reliant or self-sufficient consumption-led economy. It needs to export stuff to the rest of the world. So it needs the US to run these massive trade deficits because it can only consume insofar as it exports to the rest of the world. Now, the problem for China here is China is sitting on about 3 trillion of US treasuries. Well, what are those treasuries? That's debt that China has effectively funded for the US government. And where has that debt gone? Well, it's gone to buy the very warships that sail through the South China Sea and deter stronger Chinese influence in Hong Kong and Taiwan and elsewhere. So fundamentally, what the trade war is about is China is trying to get wealthy before it gets old by becoming self-sufficient in high-tech products, increasing income levels. And the US, for its part, is trying to make sure China gets old before it gets wealthy, because global economic power is really centered on, and political power is really centered on income levels. The wealthiest countries get a seat at the table. China has a problem in that it has a declining population, and it can't grow wealth if it doesn't export.
Right.
So we have Trump, who's actually speaking, who's giving a press conference as we speak right now, talking about China's incursion into Hong Kong and his response to that. Now, fundamentally, what Trump wants is for Trump would be happy and the US would be happy if China would export us T-shirts, DVD players, and import the high-end Boeing planes and 3M products that the US exports. But that's not what China is going to do. So what you can see on this chart is there's a company in China called the National Integrated Circuits Fund, or it's called the Big Fund for short. And this is a venture capital fund that is run by the Communist Party of China. So it's a state-owned venture capitalist firm. And what it does is it invests in Chinese semiconductor firms in order to help drive this self-sufficiency in high-tech products and just boost wealth levels or income levels through that. So China is not going to give in to U.S. demands around trade and intellectual property theft and coming into the broader political fold. And I think China's actions in Hong Kong, make that very clear that they're willing to push back more forcefully around this. Right. Now, this would have been a major problem for the U.S., right? Because China holds $3 trillion or 1/6 of all the U.S. treasuries held by foreigners. So if China was just to dump that, the U.S. would be in significant trouble, right? You'd see yields rise, which Kevin probably thinks is going to happen, and the U.S. would have to default on that debt.
Well, let me push back on that for a second, Aidan.
Sure.
The thing is that look what happened here during this crisis. Is as soon as things got a little wonky, all Powell did was fire up the presses, and like Taylor was saying, it goes brr, 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 and starts printing all this money. In the end, if China starts dumping all these securities, what's stopping the Fed from just expanding its balance sheet and simply absorbing all the excess supply and pinning yields down lower? Like, why does it have to be as disruptive? A lot of people assume that them dumping it would be market disruptive, but when the Fed has proven that they're willing to step in there and create balance when there's an imbalance. What do you think of that?
Yeah, I think that's the case. I think the Fed can continue to expand its balance sheet, and I think they will, but I don't think they're going to have to. I think what's happening right now, so the point that you're raising is Triffin's dilemma, which is if you're the global reserve currency and you need to pump U.S. treasuries or your debt to the rest of the world, then that works up until a point where the world starts to doubt your credit quality or China starts to dump U.S. treasuries, and then yields rise and it's pretty disruptive. Now, you're right that the Fed has come in and is buying U.S. treasuries. However, there's going to be some incremental demand for U.S. treasuries beyond what the Fed is doing. In my view, I think that this isn't going to be as disruptive to the treasury market, because I think that the U.S. government has found a way around Triffin's dilemma, which you can see on the next slide. So they've done two things. So this chart shows you money market funds, which are, so money market funds are the way institutional investors would hold cash if there's a risk-off move, right? So money market funds typically hold short-term U.S. treasuries or bank commercial paper. Now, what happened is in 2016, the U.S. government passed a rule called Money Market Rule 2A-7. That prevented money market funds from holding commercial paper, or it didn't exactly prevent it, but it just made it very unappealing. Yeah, they dissuaded money market funds from holding anything other than U.S. treasuries. And so you can see here that as that rule came into effect, money markets holdings of government and agency debt has basically skyrocketed. Whereas their holdings, prime funds, or funds that hold commercial paper, have decreased, or those assets have decreased. So at the short end of the curve, the regulators have basically forced money market funds to hold U.S. treasuries. Now, what's interesting is what's going on at the long end of the curve, which you'll see on the next slide. So this table, it's not as pretty as perhaps some of the other slides in the deck, but this table shows you the details about a rule that's incoming in September 2021. So what that rule is there's an OTC derivative market, so over-the-counter derivative market. Right. And for derivative trades that occur OTC, come 2021, those will have to be collateralized. So you will have to put up collateral and margin against those exposures. Now, the BIS, Bank for International Settlements, estimates that the size of this market is at least $700 trillion, trillion with a T. Yeah. So it's huge, biggest market in the world by far. And now those things are going to have to be collateralized. Well, what can you post as collateral? So on the left-hand side of this page, I show you what the derivative asset classes are and what those margin requirements are going to be. And they range anywhere from about 1% to 15% if you're equities or commodities or other derivatives here. So that's quite substantial in a $700 trillion market. Well, so the next question is, well, what can you post? What are the acceptable forms of collateral for these trades? And what you end up seeing is, well, by and large, most of these derivatives are done in US dollars. They're pegged to the US dollar in some fashion. And so what you see here is that it's going to be the cheapest to deliver collateral is going to be U.S. Treasuries. So you can see along the top, if you post high quality government bonds, between less than 1 year maturity, you have to post 0.5% of the value as collateral, and that increases. However, the important part is the red line at the bottom, which is the additional haircut due to FX matches. So if you have a market that's overwhelmingly denominated in US dollars and you want to pledge securities other than US Treasuries, well, you're going to have to pay up an extra 8%. So what the regulators have done here, it's 8% on a $700 trillion market. So what the regulators have done here is by regulatory decree, they've turned treasuries from a typical reserve asset that ebbs and flows based on sentiment for U.S. treasuries into the lifeblood of the global financial system. So they've commoditized USTs. You need them going forward. So here, this is where you start to see, so to tie it all together, this is where you see really the delinking between China and the US. It's no longer in China's interest to be tied to the system because China doesn't want to export, it doesn't want to rely on an export-driven model to boost its income. It wants to produce those high value-added goods and services that are going to increase income levels in China and make China wealthy and give it more political power in the world. At the same time, if you're the US, you're putting in these rules that are essentially going to make the US treasuries the lifeblood of the global financial system and escape the Triffin's dilemma, which the US was facing before. So, prior to this, the US was very concerned that, well, wait a minute, if these countries start to dump our treasuries, we're going to be in some trouble here. But now it's almost like, well, the financial market is going to need US treasuries just to keep the system flowing.
Just to be clear, Aidan, when does this take place? When is the date for all of this all coming due?
September 2021, so next September.
Okay, but this will be a driver because everyone's has a year to figure it all out, right? In terms of just making sure they have all the right assets and everything, right?
Well, I mean, yeah. So the assets you can pledge as collateral are going to be gold, U.S. Treasuries, bonds, JGBs. But where can you get all of these, right? So, the ECB is holding a large share of German bonds. JGBs don't even trade anymore because the BOJ owns 48% of them. And at the same time, if you do want to pledge any of these other securities in a market dominated by the dollar, you're going to have to put up an extra 8% collateral. So the world has about a year and just over a year before treasury demand skyrockets to fulfill these collateral requirements.
Wow. That's amazing. We don't have to wrap things up shortly, but I want to just this is amazing stuff. Like I want to connect that to what's actually happening right now, because we've obviously have the U.S. dollar relatively weak at the moment, but not the U.S. dollar as it's trading against the renminbi. And do you have a view as to why that weakness is so evident in the Chinese yuan?
Yeah, so I think there's a few reasons for this. So on the one side, the dollar's weak, which I actually reached out to you about on April 23rd when I said, hey, Pat, I think the US dollar is going to weaken from here. And it's been a great trade so far. The reason for dollar weakness against let's call it dollar weakness against the wide basket of global currencies, if you look at the DXY, for example, is because the Fed had injected enough liquidity where we were seeing LIBOR OIS spreads fall, which was telling you that there was an excess supply of dollars within the US financial system. And that was actually being lent via swap markets to the rest of the world, where at some points over the last month, it was actually cheaper to borrow dollars than it was euros, despite the interest rate differential there. Now, what I think China is doing here is China was the first country into the COVID crisis, and it's been the first country to emerge from the COVID crisis. And if you look at Chinese growth, and I didn't include the slides in this deck, but it's definitely something we can talk about. If you look at China's growth, their recovery from COVID has really centered on the manufacturing portion of the economy. It's much easier to run a factory at 50, 60, 70% of capacity than it is the service sector, for example, where you couldn't have a restaurant opening or running at 50% capacity. So the Chinese policymakers instructed the manufacturing sector to start producing again. Doesn't matter who you can sell it to because the rest of the world's closed, but you need to start producing again to help people get back to work. And so what China's doing, what would you do if you have excess supply now of manufactured products in your economy, but global demand is slow because countries are locked down and global trade is weak? Well, you slowly start to devalue your currency because you need to get these products sold, you need to become more competitive. And that's what China has been doing. They've been slowly depreciating their currency, exporting disinflation to the rest of the world. And so I think this trade, again, is entrenched. And the market, up until a few days ago, hasn't really been pricing this in. So if you look at CNY spot versus the non-deliverable forward. So if you want to kind of bet on this trade, there's very little CNY or renminbi depreciation being priced in for the year. And I think that if you have access to this kind of if you can trade that type of product or proxies of that, there's some opportunity there for investors.
All right. Well,
does
listen.
That help answer your question?
Yeah, it does. Like it's really interesting where we're at with all of this, and it's amazing that this is sort of happening at the same time as we're in the midst of this global economic slowdown, recession, depression, whatever you want to call it. But well, thanks for the updates. Listen, Aidan, why don't we wrap up here with you letting all of our listeners know where they can follow you and where they can learn more about you?
Sure. So you can follow me on Twitter. It's at Aidan Garrib, all one word. You can also, on the slide deck I had sent out to you, on the cover page has my email. So feel free to reach out to me there. We provide research and agency-only trading to institutional investors. So if you're an institutional investor, feel free to reach out to me on Twitter or by email.
All right. Well, listen, we look forward to having you back in the future. Thank you so much for the update, and have a great weekend otherwise.
Thank you, Patrick. It's time I finish this operation.
All right. Have a good one. Cheers, bud.
Thanks. Bye.
Patrick, time for talking charts. What do you got planned for us?
Let's go look at this raging bull market. and which I'm a non-believer of. But what I thought was a really interesting place for us to start is just looking at this NASDAQ chart. And we're heading right back for a retest of that major high. It's unbelievable that that's a true V shape. I mean, the economy doesn't look like this, but there's no denying that asset prices are pulling this move. But what I wanted to point out was that beyond this very little end-of-day pop that we got, the entire week, the NASDAQ really traded sideways. And it actually started to diverge on some of the momentum, while the other unexpected sectors started to do well. Like one of them, the sectors that obviously small caps. And small caps just went ripping higher at the start of the week. And that's something that I wasn't expecting at all. And so a huge comeback in those. But even some of those, like whether it's the value sectors, but like you take a look at, let's say, financials, right? Like and we should even talk Canadian banks and stuff like that. Like just a big jump in a lot of these sectors that were outright dogging it. Right? They were just completely in the gutter, and suddenly everything came to life this week. Like Canadian banks, I'm just going to use Royal Bank for the sake of not having another one to type up right away. But you can see like the Canadian banks on their earnings, they all popped, right? Bad earnings, positive results on the stocks. What's your take on all of it?
Well, Patrick, I actually think that there was a huge rotation, and it occurred when the stock market, when market participants started to get a sense that the economy was going to reopen quicker than everyone expected.
Yeah,
and I think that is what is driving this recent move. And when that happened, they started dumping their high tech, techie stocks, the growth names like the Amazons and everything, and they started going into other.
Here's the momentum value chart. Like, look at that drop in the momentum value. And it was in just 2 weeks, it was a 12% drop in that rotation.
It was actually the rotation within the market was much more severe than the averages made it look like. So you had stocks that had previously been flying, and the generals, the ones that had kind of been leading, really struggled. But then, a whole bunch of other stocks took off. Now, I've heard people say that when the generals, roll over, it's time for the rest of the stock market to go lower. And that was the popular narrative. But I think I got to stop listening to so much Zero Hedge, because it seemed to be that was the popular narrative within the bears. And I look at this and think to myself, well, if they start rotating into the other markets and these kind of the Microsofts and all these other ones just kind of correct sideways, I think you could get a situation where the market keeps going, Patrick. Listen, I hate myself for even saying this shit. It's hard to even think about buying.
I'm not going to drink the Kool-Aid that.
Yeah, listen, I'm not drinking any Kool-Aid, Patrick, because I'm not getting long. I'm just not fighting it on the short side, because I think it could potentially get a lot crazier. I've been highlighting in my blog this David Portnoy guy, the Barstool Sports fella. He scared the shit out of me because he went on an epic rant about how stocks only go up. And I thought, oh my God, he's going to piss off the market gods and this is going to be the top. And then sure enough, by the end of the day today, it came back up. So who knows? I'm worried because I see all these millennials opening up, Robinhood accounts. And I remember what 99 was like. If you get the public's kind of fascination and they start to get the bit in their teeth, then they can run a lot farther than anyone expects.
No, but how about in a bear market? It's about the transfer of the stock from smart money to the dumb money, because the dumb money's got to get stuck
Patrick,
holding the bag.
Why do you think we're in the bear market? Go pull up the FANG. Like how can you say that the NASDAQ is still in a bear market?
No, all I'm saying, I'm talking about the economy, right? And yes, the NASDAQ. Okay, the NASDAQ has gotten out of the bear market. But when you look at the rest of the world, I mean, we have to stop just looking at the U.S. equity. Like, take a look at this emerging market chart. Like, I mean, we haven't even done a 50% retracement of the entire bear market leg. You take some of the European indices. I don't know. Let's say look at here's the London FTSE, like nowhere near a retracement in there. I mean, look, you're giving me the NASDAQ rant, which is if everyone just stared at the NASDAQ like it, then of course you're going to see that, but you're not catching that same chart everywhere in the world. And,
yeah, but
and
Patrick,
that's maybe just a channeling of money there.
But it could. I'm not disagreeing, but
so is it a bull market just because the NASDAQ is?
Well, it's a U.S. stock market bull market. That's all I know. I would argue,
but that's only a few sectors, right? Like there are other sectors that are just. Are you? I don't know. Are you bullish on the auto sector right now?
No, so Patrick, I'm not bullish on anything that way. I'm trying to argue that everyone's telling me it's a bear market, and I'm saying the charts are telling you something different. Like when will this no longer be considered a bear market? So Patrick, like what would be your criteria for this to no longer be considered a bear market? Like how much does it have to go up for to no longer be a bear market?
No, I actually. To me, it's actually not how far necessarily goes up, but rather how it behaves during the next sell-off. Because if the bear market is over, then the next major break in the market will be bought on dip. And if the next break in the market sells and is heading right back down to the lows, it's still a bear market. And so you won't know that until it turns. And so to me, it's not like whatever. So the NASDAQ goes and does a full double top retest and the S&P goes a little higher. It's all about the next sell-off to me. And that's where we'll get the tell.
But just don't miss.
If the next sell-off is bought on dip, then I might have to change my tune.
Okay. But don't peg me as like a bull. I'm not a bull. I'm just not a bear like the rest of FinTwit.
Right. And so what's interesting is there was a few people that are looking at the VIX and the fact that it's bleeding out this way. And this is actually also going to be a really interesting chart. Some people are observing the gap that occurred on the VIX down along the bottom end over here. But one interesting thing that we see characteristically is the fact that bull markets tend to be what will draw volatility back down into the teens. And that's if you're asking me another indicator to watch for whether this is a bull market or a bear market, if this is a bear market, we won't see volatility in the teens. Volatility will stay north of 20 during this entire rally, because volatility premium will have to stay rich. And if we're going down to the mid-teens again, then probably the bear market may be over. I mean, to me, I don't think in a bear market scenario we go down the teens. What do you think of that idea?
Well, you know me. VIX is just always a sell for me. It's too many years on an institutional equity derivative desk, and I always find that most of the times that volatility is overpriced and people overpay for options. I understand the Taleb argument.
Yeah, but when you look at what the markets are capable of doing, at what point is the right price of volatility? I mean, yes, it was way too high up in the 80s, but I mean, when we're getting down to the mid-20s here right now, I mean, at some point there is a certain amount of inherent risk where they would be essentially giving option insurance away for free just because all the Robinhood accounts are buying. Look. If it's a bear market, I seriously doubt we get into the teens, is what I'm saying.
Well, I'm not disagreeing with you there. The one pushback I will have, Patrick, is that in 1999, although there wasn't a VIX and you couldn't trade the VIX back in 99, they might have recreated it kind of after the fact. But the reality is that in the final year in 99 to 2000, even as the stock market was rising, at least historical realized vol was also rising. So this idea that you have to have lower vol for the stock market to go higher, I think, is a false kind of narrative that often people just kind of blindly assume. So and that's the actual volatility. And then, well, there you can see it in 99. Let's just have a look there. Let's pull it up.
Yeah, no, it went like I had it up there. It went down to 20 during that period, right? Like it did.
But the other interesting thing was that, don't forget, that's what VIX is always what people are paying for, that volatility. The actual realized volatility was running high.
Yeah. But so notice here that during the entire 2000 to 2003 period, volatility never got back down to the teens.
Right,
in
okay.
any sustained basis, right?
Okay, but
and so this is my whole argument is that if you looked at where the average volatility was during the entire bear market, it was mid-20s.
But no,
right?
Patrick,
And
you just drew a line from 98 to 2000, and I would argue that you drew it from 98 to 2003, but among there was 98 to 2000, which was kind of a move that was what 300% in the Nasdaq.
but volatility during that period. Well, you know what though? I would argue though that the Nasdaq, and I guess this is the circumstance to one degree or another today, is we're staring at the Nasdaq versus the rest of the market, because the S&P and the Dow were not in a raging bull market in '99. Only the Nasdaq was running.
Right, but
so
that's
the S&P, that's a deja vu. That's a deja vu of today in some degree.
Well, I'm not going to disagree, but don't forget, even in '99, the S&P still hit a new high. It was dragged along. Sure, the Nasdaq, it didn't go as much as
barely. Anyway, but listen, we can explore this more over the coming weeks. I just simply want to point out that watching this VIX. Will it go back down? Like if we start seeing volatility back in the teens on a sustained basis, I might at that point have to start saying that maybe something is different. But I'm not deviating from my thesis right now. Anyway,
I admire your conviction, Patrick.
Yeah, and the theta burn.
It's a deep burn.
It's a deep burn, and so the last thing I wanted to just touch on is obviously the dollar. And you are all over this, and I'm a seller on your idea, by the way. And but what's interesting, and that's a good thing for you.
Yes,
because
that's
if
true.
we agreed, it would be a bad thing.
You're absolutely right.
And so I'm not gonna kind of jump onto your bandwagon for this dollar bear thing. I think that this is going to be a fake out, because to me, this is really just about the euro, right? And so the euro is definitively where this pop has happened, and with a 57% weighting in the Dixie, this is what's driving it. Okay. But it's hard to find, other than maybe the Canadian dollar, where the currencies are really breaking out. The pound is a little stronger off of the bottom, right? I'll look at the U.S. dollar yen for you; it's flat, right? The renminbi is just barely bound. Here, I'll look at it. U.S. dollar renminbi is just coming off of its a fresh high. Only the Canadian dollar kind of had a pop earlier in the week, and the Aussie dollar even just holding up along the highs. This has really just been a euro move as a sole currency. And my thing is that if I was going to be bearish the US dollar, I'd want to see the entire cross-currency complex starting to deteriorate, not just a little euro pop from an oversold pound. So I'm not convinced that this dollar move is for real, buddy.
Okay, well, that's good. I like it. But listen, while we're talking about the renminbi, I got to give you kudos. You've been pounding the table on that one, and you were absolutely right. It broke out to new highs.
Yeah, but what's interesting is that it's not real. I
know, Patrick. You've been highlighting.
No, I know, but
stuff.
this is not really a break to.
No, I know you were hoping for it to really explode.
Well, no, I'm not hoping.
No, you were watching
big money here. This is, I think, is going to be a really important story to watch, and right now certainly it's reversing off that level, but. Anyway, it's something that we'll have to continue watching in the days to come. Anyway, that's our little talking chart segment.
Okay, Patrick, time for this week in trading history, and I actually don't know. I did not look at the script or have any idea, so I have no idea. What do you got?
Well, this week we're talking about Abraham de Moivre. And
okay, well, I got to give you a hard time. I know Patrick, all of our French Canadian listeners are going to basically be shooting you for that.
That's what I'm going to say this entire thing.
Okay, it's de Moivre.
Oh, de Moivre. Okay.
Okay, there you go. You did it. Well done.
Anyway, so he's a French mathematician.
Yeah.
And he was born on May 26, 1667. And it's an important little history for him, right? He was the first to publish the book on probability theory called The Doctrine of Chances. And the book laid the foundation for normal distribution and standard deviations. And although at the time it was basically seen as a handbook for gamblers in games of chance, like dice, cards, calculating the odds of specific outcomes, like, what's the chances of drawing 4 aces and things like this. But it laid the foundation of everything we know about statistics today, or at least probabilities. And so he was born in Vitry in Champagne, France, on May 26, 1667. And although his father was not a wealthy man, Abraham's education was spared no expense. Without going into much detail here, Kevin, let's just say the young Abe was good at math. Now imagine that. Just stop for a second. Imagine that, being good at math in the days before calculators, right?
Yeah.
Now, Kev, think about it. Now, actually, you do know a little bit about this, don't you? Because you used to calculate your theta burn on an abacus, didn't you, back in the day?
Yeah, that's right. That's what I figured out. I just every theta burn, I would just throw over the little marbles or whatever it was that are attached to the
you'd figure out your situation, right?
Yeah.
And so you probably even found a way to spell boobs on it, right, on the abacus. It's anyway. So at the age of 21. He fled to England to escape religious persecution by King Louis, who we've talked about in past episodes. So fresh off the boat and eager to continue his pursuit of knowledge, Abraham ironically had a chance encounter with Sir Isaac Newton. And although the two became friends, one of them had a much more normal career, pun intended. But unlike Isaac, who had a cushy academic post, Abraham survived on fees from private math lessons or lounging in coffee shops where he played chess for money or sold advice to gamblers or insurance brokers. And so one of Abraham's first discoveries was his work on planetary masses. Now, funny enough, Kevin, any mention of planetary masses, it's a great time for a yo mama joke. But I decided against it because I'm sure she's wonderful and even a saint, even a very hairy saint. But now Abraham's life works focused on statistics and probabilities, with the most widely recognized work being normal distribution. So essentially he showed that a series of random sampling gave clusters of results around the mean, one where you can calculate the mean and standard deviation, and you can determine the probability of a single data point falling within a given range of possibilities. Note that 68% of the results fall within one standard deviation of the mean, while 95% within 2 standard deviations. Now, so Kev, you're going to have to wake up here, because here comes the payoff, right? Today, we use standard deviations for market calculations, everything from in technical analysis. We use it for indicators like Bollinger Bands, where the center line is a moving average with the bands being 2 standard deviations away, or whether measuring volatility for option pricing or risk managers calculating VAR. It's still we use all of the calculations that originate from him. And so I'd even argue that Abraham was one of the OG quants. And he was so data-driven, he even timed his own death. It's rumored that Abe noticed that he was sleeping an extra 15 minutes per night and correctly calculated the date of his death as the day when his sleep time reached 24 hours. Well, according to his math, he died right on schedule on November 27, 1754, blind and broke. So although he was the first person to calculate the odds of winning a lottery, Abraham never hit the jackpot.
Oh.
It's
well, you know what I just could think about is that as his sleep increased, those must have been some pretty short days by the end.
Oh, yeah.
You get up for
sure.
like 20 minutes and then you're going back to bed.
Anyway, that's the origins of so much of this.
I like Abe. I kind of like him. I like the fact that he would sit at a cafe and just sell his kind of probability
true
knowledge.
Entrepreneur.
Yeah, I like it. Thanks for sharing that with me.
There you go. All right, Kev. Let's bring Taylor on for the WTF clip. I'm so used to you setting it up.
Well, now you have to set it up, and I just sit back. This is so much. This is so easy for me. Pretty soon I'm going to be like kicked off the show.
Now, Taylor, welcome. So the I kind of brought this one up, and I wanted you to mash it up. So because it was my idea, it's probably not going to be as good. But but it
was good.
Yeah. So tell us what you set up for us.
So based on that, like I saw a clip of it, and then you sent it over, and you were like, "This is a kind of a big deal." And I looked into it, and so I created this mashup with this YouTube show called Hot Ones. And if you don't know it, it's that YouTube show. They got 9 million subscribers. It's pretty much a guy interviewing celebrities as they eat progressively spicier wings. So it's super popular, but there's nothing spicier than two millionaires yelling at each other. So I call this one "Getting Spicy" with Joe Kernan and Andrew Sorkin.
All right, let's watch.
I'm Sean Evans, and you're watching Hot Ones, the show with hot questions and even hotter wings. Joe, welcome to the show. You're about to have a horrible time. So excited for number one, the classic.
How can the stock market be here when everything else is...
And that's the question.
Starting to heat things up.
And there are a lot of smart people who have that view. You may not have that view.
Why is that the smart people? They've been wrong for 35%.
Look who's back. Look who's back.
Hold on.
Why are you yelling at
I'm
me
not,
now?
Joe. You missed it 100% on the way down, and you missed the 100,000 deaths.
You just yelled again. I don't know. I'm just trying to...
Go ahead.
I'm sorry?
No, you're not, Joe.
This is what I live for. This is why I get out of bed in the morning, Joe, to go face to face in hot sauces against another legend.
All you did was try to help your friend, the president. That's what you did. Every single morning on this show. Every single morning on this show. You abused and abused your position, Joe.
That's totally unfair.
You abused and abused your position.
I'm trying to help investors.
Wow, you know what? Like, when I saw that, it was like Sorkin had something built up on a chip on his shoulder, and he was just given the opportunity to just let loose.
Oh yeah, he's had to work with Joe Kernan for how long? Like it would drive anyone nuts. Like that Joe Kernan is the world class, asshole. Like he's just like, not that like I'm not trying to pick a political point of view, because I think that Sorkin's wrong about some of his the politics or whatever, and plus I just don't want to get into that. But Joe Kernan is a jerk. Like let's face it. And it just kind of he snapped.
Yeah,
he's like the champ.
Snapped on, and they aired it.
It was awesome. That was the best part, because you could see Joe was just like, oh wait, like he was surprised at how hostile Sorkin was.
Oh yeah. Oh,
yeah.
I'm sure that's going to make it pretty awkward. I didn't watch any afterwards, but I think that it's going to be pretty weird for the next couple months.
Might be more than a couple of months. I suspect they dislike each other like all the time, though.
Well, that's what makes a good show. Like, look at me and you.
Yeah, exactly. I can't believe I have to put up with you for this 2 hours every week. Anyway, thanks a lot, Taylor. Another great one. Yeah. Thank you very much.
Of course. I love it, guys. Thanks.
All right, time for the top 3 things to watch next week, but let's review last week's, Kev. And so we're talking about junk bonds, and really, nothing really happened too much that changed from last week. I mean, I'm still a seller on this idea, but they really have not done much. I mean, they initially popped a little bit with the whole equity market, but it's really still there.
I don't know, Patrick. I'm going to take the other side of that. I'm actually surprised at how well junk's doing. I don't really get it.
I'm shocked.
I know that the Fed is buying some. And just so for those who want to know, actually I looked it up. They purchased 1.255 million shares of HYG this week. So it's $100 million of it. It's not that much, like in the grand scheme of things. It's not that much. And yet these things are just bid. And I'm with you. I'm actually, if there was a part of the market that scares me, it's junk bonds, because there's companies in trouble, and yet these things just they gotta bid.
Well, purely from a technical perspective, the breakout has not been a fake out. No matter how much I'm skeptical of it, the breakout's held all week anyway.
Okay.
So we were talking about those GDP numbers.
Yeah. So what were we talking about them? Because I always say that they're not that important, and I don't think they were, right?
Let's just go on.
No, but I always argue that GDP is like a backward-looking, useless indicator.
Yeah.
Did I let you put them in the top 3 things to watch last week?
You gave me permission.
Yeah.
Thanks,
well. Did they move the market? They did not.
Oh, of course not.
Yeah.
That's
what were they? Let's go pull them up. Like what day was that?
Let me take a look here.
It's kind of embarrassing that we're not more on it, but that was how useless they were. Let's just look. 22.
All right, here we go. No, I'm pulling it up right here. So we had the U.S. GDP at -5, and where was the CAD?
What was they expecting?
The Canadian came at -7.2, which was,
and they were expecting,
was expected 9.
Yeah, see,
expecting 9, so a little bit better than expected.
Yeah,
and the U.S. was expecting -4.8.
Yeah, well, okay. Well, that doesn't surprise me. The Americans are eating our lunch because we're sitting there not doing nearly enough to fix our economy, and they're doing much more. But anyways, let's keep going.
Yeah.
Don't want to turn
Otherwise,
it into a this one. This was mine. This one was mine.
Yes.
Meng Wanzhou extradition decision. It occurred. It was bad, and yet nothing happened. Yet another proof of why trying to put geopolitical events and trade around them are almost impossible. I have a good friend that I argue with this about all the time because he loves, coming up with all these geopolitical scenarios. And I'm always like, okay, great. So tell me now how you make money off of it. And I would argue that if you had said to somebody, CNH is going to break out, the Trump is going to go tweet all these things about China, this is going to get worse, and then ask them to pick like what trades they would do, they probably would have said I'd sell the stock market short. I'd go do all that. And then meanwhile, the stock market's rocketing to new highs. I think it's extremely difficult.
This is where I always say in the macro tenets when I do my videos is that their fundamentals are based upon the long term, and the short term is based upon liquidity. And the thing is that if the liquidity on the short term is driving markets higher, then the fundamental we could diverge from the fundamentals for an extended period of time before they reconverge. Fundamentals work over the long term. But this is the thing, is if you're playing a geopolitical event, it's not enough to turn the liquidity alone. You need the liquidity conditions to be there for the sell-off, right?
Well, and not only that, Patrick, a lot of times with the geopolitical events, what you're doing is saying, okay, there's this really bad thing that could happen. And the market thinks that it's a 1 in 50 chance, and I think it's a 1 in 10 chance. So yeah, you can go bet on that. But then you actually have to have that event happen eventually, and for you to have gone and put that bet on over and over and over again until you finally get the one time that pays off. And that will happen. Someday we will get a geopolitical event that pays off and that the market is underestimated. But unfortunately, in the meantime, what happens is that you get all these people getting all excited about something, and it goes down for what, an hour? 2 hours, and then next thing you know,
then liquidity takes over.
Yeah, so that's why for me, I've always found that although I love to think about all the geopolitical events, it's rarely made me money.
You just like green arrow up, red arrow down. You're just like follow the trend, right?
Well, no, I'm not that. I'm actually more interested in what the liquidity and the specifics of the market are, as opposed to
and rightfully so.
The domestic conditions can affect it a lot more than anything else.
Yeah.
Okay. All right, what do we got for next week?
Let's go for next week. Well, what I want to watch is what's happening here in the lumber and home builders. And so what I wanted to start off with is just looking at, and this is, again, you know how we talked about the VIX and the talking charts and how, it will stay up in the 20s if this is still a bear market, is my view. At the same time, I think that if we're still in a global economic recession, things like lumber are not going much higher. Like if lumber goes screaming back to those February highs, then those are the kind of canary in the coal mines that something different is happening. But whether you look at lumber or whether you look at something like even copper here, let me just pull up a copper chart. They look the same. A rising wedge formation from a very oversold state. And I would argue that these are not bullish charts yet in my mind.
Why?
And what?
Why aren't they bullish?
Because they're just reflexive wedges that from a very oversold state. Whenever a market sells off and crashes lower, it's going to bounce. And the bounces last even several months and usually do a 50% retrace or whatever, 61.8 if you want to use fibs. They basically bounce, retrace the sell-off, and then they resume selling. And the thing is that these charts to me have all of the characteristics of like of just simply a reflexive bounce from an incredibly oversold crash, and so we'll watch. Now the home builders was the other part of this, and they went screaming higher, like everyone's ready to buy now. And but what's interesting is one chart pattern that we often look at in technical analysis, the bearish engulfing candle. Right, and that's this big monster of a red candle that come and engulfed the previous day, and it will be really interesting to see whether or not this has marked a swing high or not. And so if we see that lumber is running out of momentum and the home builders have done a big reversal, and even then, like, look at the momentum that stocks like, let's say, Home Depot have been doing, which are big components in these home builder indices. I know you like the ITV because it doesn't have as big of a weighting, but it really has become big weightings. And these stocks have rallied like there was no bear market at all. Right? I mean, amazing turns here. It'll be really interesting to see whether this is where they pause on this advance or not, up along these previous highs.
Well, you know me, Patrick. I've been a big home builder fan for a long time.
And you still are, though?
Oh, yeah. Yeah. Listen, Toll Brothers said something that they haven't had this many deposits on new homes since 2005.
Really?
Yeah. I think there's a chance that we're greatly underestimating the demand out there on these things, and I don't even know how. But I just
no, yeah, you know what? Because usually 20% unemployment is something you can directly associate with new deposits on homes. That's the two. That correlation is very evident.
Patrick, I'm not going to sit there and and argue that because
consumer confidence has never been stronger. Like, yeah, you know, I'm ready to buy a home now.
Well, you know what? You can laugh at me. You were laughing at me the whole way up.
I was.
And yet, meanwhile,
you know what? If we vol adjusted that bet, you would have lost, dude. You know what? The our TLT home builder bet. You know, you were just lucky that
I was lucky that a once in a
that I was
once
a
in a
fool.
100 year.
You're lucky that I was a fool.
A once in 100 year pandemic didn't show up earlier.
No. The fact is, forget that. I didn't need the crash in home builders to have won that if we were vol adjusting it. The fact is, we went bonds against equity straight up, and they were both rallying. If we vol adjusted the returns, I would have smoked you on the TLT trade.
Okay.
Anyway,
you sound like a great
you won.
Trying to argue.
You got a burger out of it. Congratulations. But
number two. What do you got? What do you got for number two?
The ISM and jobs numbers coming out in the U.S. next week.
Okay, so I crapped all over unemployment. I crapped all over GDP numbers because they don't mean anything, but job numbers do mean something, and ISM means something because ISM is actually one of the more sensitive,
forward-leading.
It's a little more real time than some others. So I think these are both big things to watch, and let's just see if they affect the market. But keep your eye on it and do a little better job than I do.
All right, it's going to be important to watch. And then finally, a little bit of watching Europe. We did this one for Andreas. The ECB's next week, right? And then not only that, here in Canada, the Bank of Canada is coming out with a statement. What's your thinking here?
Well, you know, I'm actually having to pause. Andreas has made me realize that maybe I am being too harsh about this the recent agreement between France and Germany, and maybe the scenario that I always thought would happen is finally happening. And Patrick, there's a good chance. You know why? Because recently I've expressed all sorts of dismay about the possibility of occurring, meaning that Don Cox line, those who love it best like it least because they've been burned the worst. That's basically going to be me with Europe. And the fact that I gave up and I'm not all over this trade is maybe why it might.
Well, you haven't been long Deutsche Bank with me for the last 3 days?
No. Did you buy Deutsche Bank?
I'm not going to say anything at all.
Oh, I didn't know that.
No, no.
You're
you're
not.
Never.
Oh, okay.
I would never.
Why? It's a quality company. It's a very clear, easy to understand balance sheet with very little off balance sheet risk.
Yeah, with almost no derivative exposure in the $50 trillion range.
It's like there's nothing there, but it'll be good, man. It'll be fun.
Any comment on what you think is going to happen in Canada?
No, I don't have anything. Do you?
Okay. No. Look, you know what? We've been lagging. Obviously, our shutdown was harsher than in the U.S. And it'll be really interesting to see when they try to restart everything. But monetary policy is going to continue to be pretty loose, right? And I mean, it's hard for them to do anything but provide accommodation, right?
One thing I will say though is that Polaz, who's leaving and then replacing him, but I think this is still Polaz. He's actually been talking fairly hawkish that he thinks the bounce is going to be much more V-like than most, let's just say, private sector economists are saying.
Right.
So that's just something to keep in mind.
I'm a seller on that idea, but maybe I'm always too bearish. So.
No, I've never known you to be too bearish.
No, never. Anyway, that is your top 3 things to watch next week. So let's get to Kevin, who came up with this great parting words of wisdom that he didn't actually copy and paste into here. So Kevin, why don't you read to us what you really meant to say?
So Patrick, I didn't do one. I guess you're setting me up because I didn't do one. I'm sorry, folks. I got no parting wisdom. The parting wisdom is to make sure you do your job so that your partner doesn't get mad at you. No,
stop. Do you want to quickly do one?
No, that's okay. I think that's it.
So I'm not going to do any parting wisdom. Let's just go straight to close.
I actually have one. Okay.
All right, do it.
Okay.
Do it.
Here we go.
Okay.
Well, that's it for us for another week. Thanks for joining us. We appreciate your time and hope to see you again next week. Before we leave, I want a big thank you to Andreas Steno Larsen, especially for him making time in front of his wedding. And then also a big thanks to Aidan Garrib from Pavilion Global Macro. Markets. I always say macro, but it's markets. Anyway, it's just a reminder that Market Huddle is available on iTunes, Android Play, Podbean, Spotify, and YouTube. Go do whatever Lena wants us all to do. She wants us to ring the bell or something or other. Please do it. And also, I do know this. If you can go onto Apple iTunes and leave a review, it would be much appreciated. Helps other people find our show, which is what we're wanting to do so that we can get more great guests like Andreas and Aidan in the future. I know there's a lot of different choices out there, and we just want to thank you for spending time with us. And that's it. So a big thanks from Kevin and Patrick. Where can they find you?
You can find me at Patrick Ceresna on Twitter, as well as at bigpicturetrading.com. And where can they find you, Kev?
They can go to Kevin Muir for Twitter. And if you want to go and look at my letter, it's themacrotourist.substack.com. So thanks a lot. Thanks for joining us. We'll see you again next week.
Thanks, everyone. All right.
Okay, everyone.
You know what? What a great recovery you had there.
That was so good. I'm so impressed.
I know. Like Lena came out like, "Oh my God, you guys fucked this up all over again," and then suddenly you came in with this awesome close.
That was so awesome.
Oh God, yeah, because it's not our usual terrible stumbling around. So Lena's on here. Taylor's on here. I think we should just let the millennials talk, Patrick. You and I should just sit back and listen to what
I'm just going to keep drinking. I still have a...
Had I known, I would have prepared some more Yo Mama jokes. But I don't have that right now.
So for those who don't know, Patrick and I don't know, we know what Yo Mama, we know that making fun of your mother is a fairly common joke, but we didn't realize there's a whole show about it. Or at least I didn't. Patrick, did you know about that?
No.
A whole show? There was a whole show of just mama jokes?
Yeah, it was really, really bad. I think it was like an MTV type of show where they just had D-class celebrities come on and or host it, and a bunch of kids trying to flex on each other, just saying yo mama jokes, and it was bad, but
well, Taylor, you should tell us a couple of them, because you had a couple that I liked. The belt one was good.
Yeah, it was funny because Patrick's doing the Yo Mama jokes, he's like, am I saying these right? And I'm like, guys, it's standard Yo Mama jokes. And you guys are both like, I don't know what that means.
And I'm
like,
laughing over
here.
Yeah,
he gets it. Like a standard Yo Mama joke, like Yo Mama's so fat she puts on her belt with a boomerang.
I like that one.
So big she can be seen from space.
Oh.
Yeah.
Okay, well, I guess I guess that's just Patrick and I don't have a clue what we're talking about.
No, but normally it's just me not having a clue. But you joined.
Listen.
Now you know what it feels like to be me every week, right? Like you guys start talking about a show. I'm like, yeah, okay.
Well, no idea.
How does it feel to be on the other side, Kev? It doesn't feel very good.
It doesn't feel good at all. I just feel old and out of touch.
I think anybody that's listening to the show this far, they should tag all of us, or at least to the Market Huddle Twitter account, and send us their Yo Mama jokes.
Oh, there we go.
Okay. So you guys can get used to Yo Mama jokes.
There we go, Yo Mama. God, I can just see all the Yo Mamas coming.
That's right.
Oh, yeah, this is going to be a disaster.
By the way, did you guys watch Jeffrey Epstein thing on Netflix?
No, you know what? I'm going to be so furious that I can't bring myself to watch it. Because I'm going to want to kill whoever knew all that shit and just want to, like, strangle the guy.
It is. I'm blown away.
Yeah, and it was so many people knew, right? Like, it's just shocking. And it's just like, it's oh, God.
Yeah, so many people knew, and it went for so long. That's the problem, right?
Yeah.
But,
and it's just like everyone
well,
turns a blind eye.
It just became normal, right? Like when something goes on that long, everyone just accepts it. That this is
but
the
Patrick,
way
it's more.
I'm not saying it's okay.
I know you're not. I know you're not. But what pisses me off is that people in the positions of power had the ability to call it out, and they were all too scared or didn't step up and do the right thing. And Ben Hunt has been all over this Epsilon theory, and I've been a huge proponent of him and the fact that he's standing up and saying, no, you guys should have called it out. Like, there's people like Summers is friends with him, like that. The Larry Summers is friends with him. There's a whole bunch of people who would have known. And then like, this is my problem as well. Like the Clintons, like, you're telling me Bill Clinton didn't do it?
Oh, if you're president,
was there a cigar involved?
No, but
exactly. Like,
but you know what, Lena? I actually used to make jokes like that, and I actually kind of think that too often we make jokes like that, and it's actually hurting her instead of hurting him. And he's really the one that should have been, like, he abused his position of power. I understand he didn't force her to do anything, but like a 50-year-old man should know better than to go do that to some intern.
They're underage. They don't know.
Well, Epstein is actually illegal. So like that one is just like sick, and like we should be getting rid of him. Like, anyways, it just pisses me off. But even Clinton, and this is my problem with like Hillary, is that she vilified her. Hillary vilified.
Oh, you're talking about Monica.
Yeah, and I have lots of problems with that, and it really pisses me off. And the problem is that now we're faced with we have Trump, who's obviously did some terrible thing towards women, and then we got your weird uncle Biden, weird crazy uncle, and he's just as bad. Like, not just as bad. I shouldn't say that, but he's not, like, there's shit there too. That's why we should almost just like put a woman in charge and just like not let any of these men, because they're just a bunch of. They're so disappointing. Like, so disappointing that way. Anyway, so Lena, I have not watched it because, as you can tell, I feel pretty strongly, and it's going to piss me off.
It will piss you off because I didn't have any. Not that I didn't have any opinions, but I didn't know the extent of how bad it was, to be honest, before I watched it. And just like after the first episode, I was like, "How can this happen?"
Wait, there's more than one episode?
It's episodic. There's 4 episodes.
Yeah.
Wow.
So
was it like 4 hours of shit?
No, I think it's well done. They go.
But like, it's 4 hours of like no, I mean like as in like the length of the whole thing is like 4 hours.
Yeah, they're an hour long. And
like an hour-long episode. Four episodes.
Yeah.
But speaking of Joe Biden, have you guys checked out the DonaldTrump.com or DonaldJTrump.com website? And if you last time he was campaigning and he was up against Hillary, whenever you type after the .com/whatever, if you put in some gibberish, it used to have a Hillary's picture and some sort of a saying on it. Now You have to go check it out. It's got Biden on it, and you have to look at it right now and tell me what you think.
How do I do it? How do I get there?
So go to donaldjtrump.com.
Yeah.
And then /.
Yeah.
And then just put in whatever letters, and then just enter.
Because I did that oh.
Right?
Now that's well done. Wow. That's well done. That's
funny. They used to have Hillary on there for last campaign, and now it's Biden, and it's hilarious.
Well, that is funny. That's well done.
And do they change? I got the one that appears you're as lost as me.
Like Biden, yeah.
Yeah, that's pretty funny. I actually like that.
I guess Patrick didn't find it funny.
I thought it was funny. It's a picture of like your old senile grandpa. It's like your old senile grandpa sitting there. Well done. I always like those kind of jokes, those inside jokes.
Thought I'd be on a higher note than Epstein.
Yeah.
So.
Well, that's good. No, that is actually good. Trump Epstein. So, Taylor, did you watch anything? Lena's busy watching things that are making us all sad or furious.
Yeah. No, I've been doing a lot of original Law and Orders, like season 10. Nice. Like I just hook them up because I'm a cord cutter. I don't know, like when you guys are talking about. That's why I missed the cable news thing, because it's like I have no, unless it's become like a meme or like a clip where someone like something crazy happens. I completely miss it and I don't know it. So the only thing I see is on Twitter or like that's it. Like,
so listen.
Twitter,
Law and Orders. I don't know about you, Patrick, but like my wife and I grew up watching those. Like it used to be A&E at 10 o'clock. I used to watch them like original. Like forget about like you guys watching them. I watched the original ones, and that boom, you know the sound. I've been meaning that we got to get that into a WTF clip. So sometime along the way, we got to make a WTF clip about like a boom.
Yeah.
What's amazing to me is that the Law and Order SVU unit is still going.
Yeah, I actually haven't seen any of those new ones. Like none of them.
Yeah, I know. Well, because you don't have cable. But did you watch the old ones? The SVU?
Yeah, no, not the SVU. Just like the ones with like Jerry Orbach.
Yeah.
Like
with the Baby's dad from Dirty Dancing.
Yeah.
Yeah, we always used to joke and say nobody puts Baby in a corner. That's how I always remember Jerry Orbach. Nobody puts Baby in a corner.
You guys might get this because of the. You guys know there's this comedian John Wayne who's a kind of like a boomer. He's a boomer Canadian comedian. He's really really great. He had this bit on Just for Laughs, and he goes, I'd be laying in bed at night with my wife, and we've been married 15 years, and she'd turn over to me and she'd say, "Hey, we could either watch Law and Order or we could make love." And I'd turn to her and I'd say, "Is it a new one?"
I like that.
I hope he doesn't get wind of that because I did kind of butcher it. But you get it.
That is good. I like that. John Wayne, the Canadian comedian. There he is. Oh, he's dead though.
John Wayne?
Johnny
Wayne. I
Wayne.
think you're looking at Johnny Wayne. I just looked it up too.
Oh.
It's not the same person.
How do you spell Wayne?
Wing, like a chicken
wing.
Like
John
one.
Wing. I'm sorry.
Yeah.
Oh,
John
there
Wayne
he is.
Jr.
Oh, okay, there he is.
I heard Wayne, not Wing too.
Yeah, I heard that as well. But anyways, that's okay. He's from Sarnia. The great city of Sarnia. It's not a great city.
Never been.
Oh, well, you aren't missing much. I apologize if you're from Sarnia. The thing I always knew about Sarnia was that it's on the Detroit River or something like that. The river.
Yeah, it's right.
And they, I guess some company dumped a whole whack of dry cleaning fluid at the bottom of this river. So you could never swim in there. And then they had to it would just sit there. Like it's like sludge at the bottom. They couldn't get rid of it. And then, so they had to go and they finally spent so much money to fix it. I think it's swimmable now. Anyways, that's always what I know about Sarnia. I feel bad. I shouldn't be saying bad things about Sarnia. I love Sarnia. My brother-in-law lives very close to Sarnia, so actually I have been there, and it's not as bad. Listen, it's lovely.
I've taken that bridge before when going to Chicago.
Yeah, that's true. That's true. That is the way you go. It's on the way. Anyways, let's talk about something nicer. I should do that. I should always punch up. I'm punching down there. That was really bad of me. So
yeah, Kevin, you're being a downer.
I'm being a Torontonian jackass. Like, and not only that, I'm from like a city like this little like cold little city that even makes Sarnia look good, which is Winnipeg.
We call it Winterpeg.
Although I love Winnipeg, I don't understand why people think it's the worst place in the world. And everyone seems
the worst place in the world.
Thanks, Lena. Stick it up
We
for
went to like a dinner party like, I don't know, 2 months ago before all this happened, and the host went on like an hour rant about how she hated Winnipeg, how her work sent her there for like 3 months, and she went off on everything, every aspect of the town. She was like, never go, never ever go.
She must have gone in winter or something, because it gets pretty cold there.
I'm gonna take the other side of her trade. It's a lovely place. The people are lovely. It's terrific. It is a little cold in the winter, but it's a dry cold, so it's not that bad. And the summer is nice for those week and a half when it's warm and there's no bugs. But otherwise, I love it actually. And my best friend's from Winnipeg, and I'm obviously a Winnipegger. So I'm gonna
tell Taylor the joke that you hate about Winnipeg, but it's why do the trees in Vancouver and Toronto lean inwards?
Why?
Because Winnipeg sucks.
That's a pretty good joke. That's a good joke. That's a good joke. I agree with that.
Oh, I'm sorry.
Oh, that's okay. I'm good with it. I understand. Listen, people don't like it. I don't understand it.
You know what?
You've never been.
I'm not going to shit on it. I have nothing bad to say because I've never had a bad experience there. So I just am saying a joke I heard. That's all.
I agree. It doesn't have much of a downtown.
I would say a bad joke about Toronto too.
Yeah.
So tell us one.
I don't have one.
You don't have one.
I don't. Do American listeners know Winnipeg? Like, what is there like an American equivalent?
North Dakota, Fargo.
Yeah.
They know Fargo. They know Fargo, eh? It's great. It's great, eh?
Eh?
They know the wood chipper. Everyone knows the wood chipper scene too, right? Like, let's face it. Everyone knows the wood chipper.
Yeah.
One of the greatest scenes ever. Gonna wood chipper up, eh?
Yeah.
I'll tell you, I don't know if I've ever already said this, but my wife and I, and as a family, we decided to drive to Winnipeg, and we went the south way, and we went through all like Minneapolis, and like we went Detroit, Minneapolis, we went under the lakes. And we hit this point where we were kind of in the Dakotas, and I said, you know what, like we were somewhere, and I said, we better stop and feed everyone. Like we had some smaller kids. And my wife said, no, we'll just stop up ahead. I go, no, we better stop.
There's nowhere to stop.
Feed everyone. And she goes, no, we stop. Literally, we drove for like 3 hours, and there was like, industrial gas stations like for truckers, and that was basically it. And I was like, you cannot do this. And people from Ontario, or even from kind of more populous parts of the States, they don't understand how desolate it gets in certain parts.
Oh, yeah.
Yeah. It's like driving like when you go...
When you get to northern Ontario, even, there's like big gaps where 3, 4, 5 hours if you didn't stop for fucking gas.
Yeah, you gotta, like, it's like a serious, like, you gotta think about it. It's like
you need a full tank of gas to get to the next gas station.
Exactly.
Like it's
because you're not
seriously.
You're not
don't fuck up with this shit.
And you're not gonna see a soul for a long time. Let's remember we had that guest that he came on and he started talking.
I would imagine it would be the same driving around Australia too, wouldn't it?
Oh yeah, I think it's even worse in the inside, because I think like if you go through the middle, I think it's like you go miles without seeing anyone.
Oh yeah,
like
miles.
I mean like hundreds of miles without seeing anyone. I've never been, but I'm pretty sure it's just brutal. But remember that one guest that he came on and he started talking about like how he was in the middle of nowhere, and he'd gone he's from Calgary to Fernie, and he was talking about how crazy it was. And I was like, Calgary to Fernie? Jesus Christ, that's like there's lots of things between Calgary and Fernie. That's not in the middle of nowhere. Like the middle of nowhere is like when you go past Sudbury. And that's when you get into some real Canadiana. Like you're basically and listen,
that's where you get to the home of the Winnie the Pooh.
Yeah.
What was what was the name of that city? Fuck. Now I need to figure it out.
Like Thunder Bay?
No. Oh my Jesus. Now I got to figure out. You guys keep talking. I'll figure this out.
I think we should wrap it up.
White River.
Is it? Yeah, that's right. And it's just like by Horn Payne there or something like that. But that's the home of Winnie the Pooh. All the our American listeners don't know that he's a Northern Canadian creation. But yeah.
My wife's from Timmins, and in my old life I worked in engineering in New York City, and then the next week I lived there for a year, and then the next week they sent me to Timmins to work north of Timmins on a hydroelectric dam, and that was a jump I didn't want to take, and it was easily the worst 3 months of my life. I'm just happy to be back.
All right. It's hold on a second here. Okay, I got to pull up this picture here. Hold on. They have a memorial not a memorial, like a little thing. This is White River, fucking right here in northern Ontario, and there's somewhere here the Winnie the Pooh monument of some sort. Like, where the fuck is it? Hold on.
Are you sure?
Google mapping. No, for sure it is. Hold on a second. I'm gonna find this. This is this is like northern fucking. Oh my god, it's somewhere here. Anyway, somewhere here within a couple kilometers is this memorial for Winnie the Pooh. It's like northern Ontario. Anyway, I'm gonna give up, but it's somewhere right in there on that major intersection, and yeah, it's crazy up north. Anyway, you know what? Lena's getting bored. I think we're gonna have to end this. Sorry, Lena. I went on.
You couldn't find the statue. Somebody will find it and post it for us on Twitter.
Oh, hold on a second. Here, there you go. Hold on. Here we go. I just clicked on.
There you go.
White River. There it is. There it is. The home of Winnie the Pooh, right there.
Very cute.
Very cute. That's and by the way, don't bother to go visit there. It really is really nothing unless it's somehow miraculously on your way.
Yeah, I don't think anybody was planning.
There's an A&W Burgers there that you can have a nice burger. That's about it.
All right. On that note, let's wrap it up.
All right, Lena's got to go. All right, I'm done.
Yeah.
Everyone done? Have a great weekend, everyone. Great job, everyone. Great job on the words of wisdom, Kevin. That was awesome. He's gone.
Yeah, he's already peaced out. So let's go.
Okay, catch you later. Okay, have a good weekend, everyone. Bye-bye.